Welcome back to another episode of Multifamily AP 360. And today's our guest is Erik Oliver from Cost Segregation Authority. Welcome, Erik.
Thank you for having me. I'm glad to be here.
Sure, absolutely. And little bit about Erik. Erik Oliver holds a Bachelor of Applied Science in Accounting from Westminster College. Prior to joining Cost Segregation Authority, Erik was an operations manager for a multi-million dollar landscaping and design firm in Long Island, New York. Since heading west and joining Cost Segregation Authority, Erik has been speaking at local, regional, and national events. He brings with him a passion for identifying cost saving and educating commercial real estate owners on the benefits of cost segregation. So, with that, Erik, you want to add anything to your background?
No, I think that covers it. Yeah, just glad to be here. Glad to talk real estate with you.
Awesome. How did you get into cost segregation space?
That's a good question. So as the bio mentioned, I was born and raised in Salt Lake City, Utah. And then I took a couple of jobs that took me to the East Coast for a number of years. And when I was looking to come back to Salt Lake, I was looking for a job. My background at the time was in accounting, my degree's in accounting, and was looking for jobs, came across this job with a niche accounting firm here at Cost Segregation Authority, and had always been interested in real estate. I actually didn't know what cost segregation even was when I applied here. A lot of people go out and YouTube what cost segregation was, but that was about 8 years ago that I applied here, got the job. I've loved it since, loved working with investors, learned a lot about real estate. And so it's been good.
Awesome. Thank you for sharing that. And for those who are unfamiliar, can you explain what cost segregation is and why it's critical for real estate investors or commercial real estate investors?
Yeah. So cost segregation really is just accelerated depreciation on your real estate assets. So one of the great benefits of owning real estate is the ability to take depreciation against your income. So depreciation kind of acts as it's a non-cash expense. And when you buy a piece of real estate, you get those depreciation benefits. So residential units, anywhere where somebody lives, is typically depreciated over 27 and a half years. Commercial units are depreciated over 39 years. So just to make the math easy, let's say you buy a single family home for $275,000. Essentially, you're going to take $275,000 divided by 27 and a half years, and you're going to get about a $10,000 write-off every year for the next 27 and a half years. Now, I've oversimplified that a little because land is non-depreciable. You always have to back out your land value. But the idea is you take your basis, you divide it by 27 and a half, and that gives you what you call your straight line depreciation number. And a $10,000 write-off is good, but I may not own my property for 27 and a half years. I want my deductions now. And so how do I do that? I can take larger deductions up front by implementing cost segregation. And again, so just as the name implies, we're segregating the cost of your building into different asset classes. So I'm here in an office. You can see the window coverings behind me. Those are a 5-year asset. They shouldn't be depreciated over 39 years. They should be depreciated over 5 years. The carpet here should be depreciated over 5 years. The parking lot out there should be depreciated over 15 years. So what we do at our firm is we come into your building or look at your building and we say, okay, you bought this multifamily building for $1 million. 80,000 of that million is for the parking lot. 20,000 is for the flooring. 12,000 is for the appliances. We segregate all the cost into different buckets that'll allow you to depreciate it at a much faster rate. So you're getting a bigger deduction in the early years, and that creates cash flow for your investors, for you, because you're getting a bigger deduction to offset your tax liability in those early years. So again, number of reasons why people want to do cost segregation. One is they're not going to hold the property for 27 and a half or 39 years. The other thing is inflation. A dollar today is worth way more than a dollar 27 and a half years from now or 39 years from now. So give me my deductions now versus letting the IRS hold on to these for the next 27 and a half or 39 years.
Yeah, awesome. And thank you for explaining that. So can you also talk about bonus recapture, right?
Yeah.
So when we sell the property, yep, go ahead.
Yeah, let's talk about bonus. You mentioned two things, bonus and depreciation recapture. So let's talk about bonus depreciation. So bonus depreciation has been around for a number of years. The government uses bonus depreciation to stimulate the economy when they need to stimulate the economy. So the government will issue a bonus amount, let's call it 50%, and say, okay, anything you buy this year, you can depreciate 50% of it in year one. The other 50% gets spread out over the useful life. Now, there's some specific rules to that. It's not just anything you buy. For example, let's go back to 2017 where bonus really had a change. At the beginning of 2017, bonus was at 50%. It had to be brand new assets. You couldn't buy a used bulldozer. You had to buy a brand new bulldozer. And that bulldozer or whatever it is that you bought had to have a useful life of 20 years or less. And so if you bought $1 million bulldozer, brand new, you would get a $500,000 or 50% of that as a write-off in year one. The other 50% would spread out over the useful life of that asset. And that, again, stimulates or gets people to go out and buy stuff. So you probably heard about people go buy trucks at the end of the year for their business, or they're looking for write-offs. And the government says, okay, we're going to give you a bigger write-off if you go do it because we want to stimulate the economy. So that was the beginning of 2017. Fast forward to the end of 2017 with the Tax Cuts and Jobs Act. Donald Trump is our president. Donald Trump owned real estate, and Donald Trump was very favorable when he revised the tax code to real estate investors. A few things changed at the end of 2017. The first thing that changed is bonus went from 50% to 100%. So now in that example with the bulldozer, if I bought $1 million bulldozer, I would get 100% of those deductions or $1 million deduction in year one. So that's huge. The second thing, which I think was actually more impactful, is they actually changed the tax code. They added 5 words, and I'm not even sure the folks in Congress knew that those words were even added or what the significance of adding those words were, but they added the words new to you, the taxpayer. So if you remember, Rama, I said you had to buy a brand new bulldozer after the Tax Cuts and Jobs Act, So now I could buy a used bulldozer for $1 million and I could get 100% bonus or 100% write-off in year one. So let's talk about what that means for real estate investors, because I don't know how many of your listeners are buying bulldozers. So let's talk about real estate. So any assets that were bought between 9/27 of 17 and 12/31 of 2022 are eligible for 100% bonus. Meaning, if I bought a $1 million apartment building, let's say land was 200,000. Let's say I bought it for $1.2 million, just to make the math easy. So I bought it for $1.2 million. The land is 20% or roughly 200,000. So that gives us $1 million worth of depreciable basis. When we do our cost segregation study, we're going to find about 30% of that $1 million will fall into short asset life equipment. Things like carpet, countertops, parking lots, curbs, gutters. If I bought that asset between 9/27 of 17 and 12/31 of 2022, I would get that full 300,000 or 30% that we segregated. I would get 100% of that, 100% bonus of that in year one, meaning I'm getting a $300,000 write-off. Remember, your assets have to have a useful life of 20 years or less to get the bonus. So if you don't do a cost segregation study on your apartment building, that just stays on the books as a 27.5-year asset. You're not able to take bonus depreciation on that asset. But by doing a cost seg study, we now can take the 5, 7, and 15-year buckets that we find. Those are all 20 years or less, and we can apply bonus to that. So bonus was very impactful. Bonus is starting to phase out. Any assets that were placed into service in 2023 received 80% bonus. 2024 is 60% bonus. 2025 is 40%. However, Rama, there was some legislation put forth in front of Congress earlier last year, and they were looking to extend the 100% bonus through 2025. Now, it ended up getting passed through the House. It got to the Senate, and they voted it down. It didn't get passed. Main reason for that is that we were in the midst of a presidential election. The House passed it almost unanimously with bipartisan support. It got to the Senate. They decided not to pass it. Now that the presidential election is over, my guess is that Congress will get back together, hopefully soon, and put together a comprehensive tax bill that will extend the 100% bonus through probably 2026. We'll have to wait and see. But currently, bonus depreciation for this year, 2025, is at 40%. So that's kind of where we are with bonus. Rama, let's talk a little bit, if you want, about depreciation recapture, because that's a question we get asked quite often.
Yeah.
When you sell an asset, sometimes a question we get asked quite often is, Erik, this cost segregation or this accelerated depreciation, this is just a timing issue. If I take all this depreciation now, when I go to sell my asset, I'm going to have a larger tax bill when I sell it. And the reason for that is you pay two types of tax when you sell your asset. You pay depreciation recapture and you pay capital gains. Your depreciation recapture is based upon how much depreciation you've taken. So I'm sitting here saying, hey, let's front load and take all this depreciation in these early years. And then we'll have some tax preparers or CPAs or even investors themselves say, if I take all this depreciation now, that just means when I sell it in 5 years, I'm going to have a big tax bill because I got to pay a lot of that back. And the answer to that is that's not necessarily the case. And I'll back into this example, Rama, because I think it makes a little more sense. But let's say I bought this office building that I'm in here today. Let's say I bought this building for $1 million 5 years ago. And now today I'm going to sell it for $2 million. So I bought the walls, the parking lot, everything in here for $1 million. 5 years later, I'm going to sell it for $2 million. When I go settle up with the IRS, I'm telling them that everything is doubled in value. I bought the walls and all this stuff for $1 million. I'm now selling the walls and all this stuff for $2 million. So everything's doubled in value and I get charged tax on that, capital gains tax. My land and my walls have gone up in value, but certainly my carpet that's 5 years old is not worth double what I bought it for. Carpet goes down in value. Carpet doesn't go up in value. So we shouldn't be selling our carpet for double what we paid for it. So if you remember, carpet's a 5-year asset. So what is the value of our carpet after owning it for 5 years? What's the book value? It's zero. It has zero book value. So when you do a cost segregation study, it allows you to allocate the sales price to the right buckets. And so part of doing cost segregation is you're taking your deduction. So when I bought this building 5 years ago, I did a cost seg study. I got a deduction, and that deduction offsets my ordinary income. So let's call my ordinary income bracket 35%. When I sell this building 5 years later, I'm paying that back at a recapture rate of 25% or a capital gains rate of 20%, and I'm saving that spread. So in summary, take your deduction at a high rate, pay back a portion of it at a lower rate at a future date, and save the spread. And that's probably the most complicated thing we'll talk about today, Rama. But if you remember anything from what I just said, don't sell your dirty, stained carpet for more than you bought it for. And then call us and we'll walk you through how we can save you tax money on the back end.
Awesome. Thank you very much. Not many will touch on depreciation recapture part. Thank you again explaining for that. So yeah, can small investors still benefit from cost segregation, or it's primarily for large scale property owners?
Well, that's a good question, Rama. I would say when I started doing this 8 years ago, it was really for your large institutionalized investors. You had to have a large building for it to make financial sense for a couple of reasons. One, the benefit was lower. The cost of the study was higher at the time. Those things have changed now. So with bonus depreciation that we talked about, cost segregation became applicable to a lot smaller investor. So we do everything. We do a lot of single family rentals where maybe you buy a $300,000 single family home. And if we can segregate 30% of that, we can sometimes get you a $100,000 write-off all in the first year, depending on when you bought it. And yes, I would say any asset with a depreciable basis of 250 to 300,000 or more is absolutely worth looking at. Most reputable cost segregation companies out there are going to provide you a free benefit analysis. So before you ever pay them a dollar, they should give you an idea of whether or not your property is a good candidate and what type of tax savings you might be looking at. And so I would always get a free benefit analysis done on any asset over 250,000. Now, just because you have an asset over 250,000 doesn't mean you're going to save tax dollars. The reason for that, Rama, is there's something to be aware of when you're looking at cost segregation, and that is your active income versus your passive income. So typically, I'll use myself as an example. I am a W-2 employee here at Cost Segregation Authority, and I own real estate on the side. I have a long-term rental. If I did a cost seg study on my long-term rental, those deductions, let's say I created a $200,000 deduction, those deductions cannot be used to offset my $200,000 of my W-2 income. The reason for that is my W-2 income is considered active income, And my real estate deduction in that case would be considered a passive deduction. And you cannot use passive deductions to offset active income. So there's a couple ways around that. One of them being becoming a real estate professional. A lot of you have probably heard that term. To become a real estate professional, you have to spend 750 hours a year doing real estate and 51% of your working time doing real estate and show material participation in the management of your properties. So an example of that would be, let's say I'm a W-2 employee, but my wife doesn't work, but she manages our rental properties. As long as she spends 750 hours a year and 51% of her working time managing those properties, she now qualifies as a real estate professional. Because she does real estate for a living and we file a joint tax return, those deductions now become active and they can be used to offset my active income. So that's one way around it. The second way, which is very popular and you've probably heard about it, but that's the short-term rental loophole. And when you're looking at a short-term rental or an Airbnb type property, the IRS looks at those a little bit differently than they do a long-term rental. So if you have a property and the average stay is less than 7 days, so most short-term rentals, your average stay is going to be less than 7 days throughout the year, and you manage that property or show what they call material participation. Now, the IRS has 7 tests. You only have to meet one of those 7 tests to show material participation. But if you can show material participation in the management of that property and the average stay is less than 7 days, the government looks at that property more like a hotel, as if I'm managing a hotel. So I'm actively managing my hotel business. And because I'm actively managing that hotel business, those deductions become active and they can be used to offset my active W-2 income. So those are just a few ways of how you can change your deductions from being passive into active, but something you definitely want to talk to your tax preparer, your financial advisor about to make sure that you can do cost segregation. Not only can you do it, but you want to make sure you're going to actually save money when you do cost segregation.
Yeah, thank you. Are there any risks or common misconceptions about cost segregation that investors should know?
That's a good question, Rama. So there really is no risk with cost segregation. You want to utilize cost segregation when you find yourself in a high tax bracket with a high tax liability so that you can maximize your savings, number one. Number two, as far as the risk goes, you're actually doing it incorrectly if you're not doing cost segregation. Now, the IRS isn't going to come after you, Rama, if you depreciate your carpet in your apartment building over 27 and a half years instead of 5 years, because they're like, hey, this is just more money for us. We're okay with it. They're not going to come looking for you, but you're actually doing it incorrectly. So the IRS issues an audit guide that tells their agents how to audit cost segregation studies. And as long as you're using a reputable company to do your cost segregation studies, like our reports follow the 13 steps in the audit guide, and we have been involved in audits. We have clients who call us and say, hey, my tax return's being audited for some other reason. They have some questions on the cost seg study. As long as we're following that 13 steps, we can talk to the IRS agent and say, here's why we did what we did. Here's how we got our numbers. But you want to make sure you have a quality study that backs that up. So our deliverable when we work with clients is about a 50-page report that has all the detailed information of how we got to our numbers. So when our clients are ever in an audit, most cases, we just hand them their report. They look at our report and they go away. Sometimes they'll have questions about how we did certain things or how we got to certain numbers, and we jump on the call with the agent. It's part of the service that we provide and say, hey, here's how we got to the numbers. Here's the answer to any of your questions. And then they go away. So I would be a little bit wary of the online kind of do-it-yourself cost segregation studies. They're kind of like the TurboTax of our industry. And I have seen in those cases where there have been audits, they're very hard to defend because there's not a lot of backup documentation. So basically on those online studies, you go onto a website, it asks you a list of questions, you pay $1,000, you hit submit, and it spits out a report. What the IRS doesn't know, they can't confirm that there's actually carpet in your apartment because nobody ever went and looked at it. They're just taking somebody's word for it. They don't know the square footage of the carpet. They don't know how thick the asphalt is on the curbs or the gutters or the driveway. And so they usually will throw those reports out and make you go pay for what they call an engineering-based study that's got more details about the property. There's a time and a place for those online studies. If you've got $100,000 tract home in downtown Detroit and you want to do an online study, maybe that's okay. But for anything over about 250 to 300,000, it definitely pays to do the engineering-based study because you get a much bigger result, number one. Number two, it's easily defendable in the case of an audit.
Yeah, absolutely. And thank you very much for sharing that. I mean, let's switch towards energy credits. How exactly we can leverage energy efficient improvements in multifamily properties, and that we can leverage these energy credits into syndications.
Yeah, so there are a couple energy credits that you should probably be aware of as an investor or developer. Um, One of them is called 179D. That's for the construction of energy efficient commercial real estate. The other one is called 45L, which is for the construction of residential real estate. So this would be more applicable to people who are developing new properties. The 179D is a deduction up to $5.65 per square foot if you're constructing an energy efficient commercial building. So if I'm building an office building and I put in good insulation, good lighting, good windows, and I have a third party come certify my building, I may be eligible for, again, up to a $5.65 per square foot deduction if my building meets certain criteria. So again, that would be for anybody who's listening, who's developing new commercial real estate. On the residential side, the multifamily, the single family, if you are building new multifamily, there's a program called 45L or the 45L credit. Now, this is a credit, not a deduction, so it becomes right off the top of your tax bill, and it's up to a $5,000 credit per dwelling unit. So depending on how many dwelling units, if you're building a fourplex and you're building them energy efficiently, you may be eligible for up to a $20,000 credit that you can use to offset your taxes. So the IRS uses the tax code to incentivize us to do what they want us to do, Rama, and they want us to build buildings that are energy efficient.
Yeah.
And so if we're using energy efficient materials, if we're using energy efficient standards, then they're going to incentivize us to do that. So both programs do require that you have a third party come in and certify them. But if you or any investor friends of yours are building new buildings, chances are they've probably not heard of these programs and they're not taking advantage of them. I can't tell you how many times, Rama, I've met with folks who are like, yeah, I built 300 single family homes last year. What is this 45L stuff you're talking about? And we were able to go back and get them a huge credit on their taxes. So just two things to be aware of. There's a whole lot of nuances. We could do a half-hour call just on those, but I just wanted to make the listeners aware that if you're a developer and you're building new construction, then you want to be aware of those two programs. It does work for renovation projects, especially like deep or heavy renovation. If you're just going in and putting in some new carpet and new paint, you're probably not going to meet the qualifications. But if you're buying an apartment building, going in, gutting the units, putting in new HVAC, new appliances, new windows, then there are opportunities and pathways to be able to qualify for some or a portion of those credits and deductions.
Got it. Thank you very much. So how exactly listeners can connect with you, Erik?
Yeah, so listeners, the best way to connect with me is through our website. It's just costauthority.com. So www.costseggauthority.com. From there, you can get my contact information. We have a place where you can get a free benefit analysis. So if you have a property that you think might be a good candidate for cost segregation, you can give us some information and we'll run some numbers to determine what the potential tax savings would look like, as well as what our fee would be. And you can also find me on LinkedIn just under Erik. It's Erik with a K, last name's Oliver, Oliver. But please use this as a resource, you guys. We love working with investors, helping them through these things. We don't bill by the hour. If you have any, don't call me and ask me questions about child tax credits or earned business income. I don't know anything about that. but I do know a lot about depreciation and cost segregation. So if you have any of those questions, please don't hesitate to reach out. Use us as a resource.
Awesome. And thank you very much, Eric.
You're welcome. Thanks, Rama, for having me.
Sure.